Imagine your country's credit score dropping, not by accident, but because the financial world is questioning how you manage debt. Today, we're unpacking why another U.S. credit downgrade is coming, what it means for the economy, everyday Americans, and why this matters right now in 2025. Hey, I am not a licensed financial advisor. The content in this video is not financial advice, just for informational and educational purposes only. Always do your own research and speak to a licensed advisor for personal financial decisions. Let's start with the basics so everyone watching can follow along, even if you don't track finance headlines every day. In mid-2025, Moody's, one of the world's most influential credit rating agencies, downgraded the United States' long-term credit rating from AA to AA1. This might sound like a small letter change, but it's huge in financial terms because it marked the moment the U.S. no longer held AAA credit score from any of the major rating agencies. But that wasn't the only action. Another agency, Scope Ratings, also lowered its view of the U.S. credit rating to AA, citing sustained fiscal pressures and weakening governance standards. These moves aren't just technical events for Wall Street, they are signals. Think of credit ratings like a financial report card for the country. A downgrade doesn't mean immediate disaster, but it does mean lenders see a slightly higher risk when the U.S. government borrows money. So why the downgrade? Agencies point to a few persistent issues. Growing national debt. The U.S. debt has ballooned over the years due to large annual deficits. Rising interest costs. More revenue goes just to pay interest on debt. Political gridlock. Lawmakers have struggled to agree on long-term budget plans. Moody's said they don't expect material multi-year reductions in spending and deficits under current proposals, which influence their decision. Now you might be wondering, does this mean the U.S. will default on its debt? Not at all. The United States still carries a very strong credit rating. AA1 is still investment grade. The U.S. dollar remains the world's primary reserve currency, and treasury securities are widely held around the world. But this downgrade does signal concern about fiscal direction and future borrowing costs. Now that we understand what happened, let's talk about why it matters, especially if you live in the United States. First, the reason credit ratings matter. They influence borrowing costs not just for the federal government, but also for the broader economy. When a country's rating slips, lenders often demand slightly higher interest rates to compensate for perceived risk. While U.S. treasuries are still considered very safe, even a small rise in borrowing costs can ripple outward. That's because Treasury yields act as the baseline for things like mortgage rates, car loans, and business financing. For example, after the Moody's downgrade in May 2025, bond yields, especially on long-term bonds, rose noticeably, indicating that investors were asking for higher returns to hold U.S. debt. Higher yields on government debt often translate to higher interest rates across the economy. That means consumers and businesses might pay a bit more when taking out loans in the future. For example, after the Moody's downgrade in May 2025, bond yields, especially on long-term bonds, rose noticeably, indicating that investors were asking for higher returns to hold U.S. debt. Higher yields on government debt often translate to higher interest rates across the economy. That means consumers and businesses might pay a bit more when taking out loans in the future. Here's another important point. Credit downgrades aren't a flash crash trigger like a sudden stock market collapse. Instead, they often slowly inform financial markets and policymakers that fiscal patterns need attention. In fact, the U.S. government still enjoys deep market confidence and a huge pool of global investors who buy treasury bonds. So the downgrade doesn't spell immediate turmoil, but it raises the bar for fiscal responsibility. And it's not all gloom. Rating agencies also maintain stable outlooks in many cases, meaning they don't expect further declines right now. This suggests that while the risks are real, They are not imminent emergencies as long as fundamentals like the economy's size, productivity, and reserve currency status remain intact. What should everyday Americans take from this? Understand that U.S. debt dynamics affect interest rates gradually. Credit ratings influence confidence, not everyday bank accounts overnight. Fiscal policy and budgeting decisions in Washington matter at a macro level. So now that we've laid out what happened and why it matters, let's move into the question everyone wants answered. What comes next? And more importantly, what should the average American understand as we move deeper into 2025? A credit downgrade isn't a one-time event. It's more like a warning light on the dashboard. It doesn't mean the engine fails today, but it does mean something needs attention. And the biggest area rating agencies highlight is the federal government's long-term fiscal path. Things like the size of annual deficits, the growth of the national debt, and how political decision-making affects budget stability. Over time, if these issues don't improve, agencies might consider further adjustments or maintain a cautious outlook. That's why many financial analysts say another shift in ratings, or at least continued scrutiny, is possible. But let's be clear, this does not mean the United States is heading toward default or losing trust. The U.S. economy remains one of the strongest, most innovative, and most resilient in the world. Its financial system is deeply integrated globally, and U.S. Treasury bonds remain a cornerstone of global finance. So then what does another downgrade could be coming really mean in practical terms? It means Washington will face more pressure to manage spending and revenue responsibly over the long term. Financial markets will pay even closer attention to future budget debates, especially during election cycles. Investors will look at the trajectory of government debt, interest costs, and economic policy with heightened sensitivity. For everyday Americans, these potential shifts usually play out slowly. You won't wake up tomorrow to drastic changes in your personal finances because of a rating update. Instead, the effects show up across years in things like general interest rate trends or how easily the government finances long-term programs. These are gradual, structural impacts, not overnight shocks. Here's a helpful way to think about it. A downgrade is like a performance review pointing out that the U.S. is still strong, very strong, but that long-term goals need more attention. It doesn't damage the economy today, but it signals where things might head if nothing changes. And financial professionals, economists, and policymakers use these signals to guide planning, forecasting, and budgeting. But here's the most important part, and the part that keeps investors confident even during uncertain times. The U.S. has always adapted. Fiscal priorities shift, policies change, and the country's economic foundations, from innovation to consumer spending to global trust, remain unmatched. Before we wrap up, let's bring everything together in a clear, calm way so you walk away with confidence and understanding. Stay with me. The final part ties everything together in a simple, relatable way you can share with anyone. As we bring this full circle, here's the truth. Credit ratings matter, but they're not destiny. They're more like markers on a long road the U.S. has traveled for generations. And the reason we talk about them is not to create fear, but to create clarity. The U.S. economy is enormous, diverse, and powered by millions of people who work, build, innovate, invest, and consume. That's why, even with downgrades, the United States remains among the world's most trusted borrowers. It's also why global markets continue to rely on U.S. bonds and the U.S. dollar. This foundation doesn't vanish because of a rating update, and it's one reason financial systems worldwide remain anchored to the American economy. So what can you take away from all of this? First, understanding the country's finances helps you understand the environment your own finances live in. When a government faces higher borrowing costs, those shifts eventually shape the financial landscape businesses and households operate in, not as immediate shocks, but as long-term trends. Second, credit downgrades highlight the importance of stable policy. Things like budget agreements, responsible spending, and long term fiscal plans matter, not just to economists, but to everyone who cares about stable interest rates and long term economic health. Being aware of these issues helps you stay informed as a voter, as a consumer, and as a participant in the economy. And third, it's a reminder that even strong economies face challenges. The key is how they respond. Historically, the US has shown a remarkable ability to adapt, rebalance, and move forward, and that resilience remains one of its greatest strengths today. As you go into the rest of the year, remember, a downgrade isn't a crisis. It's a signal, a reminder, a moment to reflect on long-term trends. And by staying informed, calmly and clearly, you position yourself to understand the changes shaping the world around you. If you found this explanation helpful and want more clear, simple breakdowns of complex financial topics, be sure to stick around for upcoming videos. And as always, this content is for educational purposes only and does not include any investment advice or recommendations. Thanks for watching, and stay informed, stay thoughtful, and stay prepared.